Welcome, students. So, in the process of learning about the estimation of the project cash flows, now we will say look at the project from the different perspectives, and these different perspectives are maybe normally the fund providers to the project, or maybe contributing towards the total funding of the project or a new venture. And in this process of learning about the funding of a new venture, we will talk about the different perspectives, or we will see the project from the different perspectives. And we'll see that if the funding is coming from multiple sources, different sources, then how to take care of that funding and how to give the return to those sources of the funds. Because depending upon the different sources of the funds, or maybe the amount of the funds coming from different sources, we have to give the returns also back to them. And while we calculate the cash flows, we have the different ways to work out the cash flows for the all stakeholders, or for the only long-term fund providers, or the equity fund providers, or maybe the explicit fund providers. So we will have to learn and to understand about that when we prepare the cash flow statement, or maybe we work out the cash flows from the perspective of the explicit funds, or maybe the total funds point of view, what are the important steps we have to follow. And if we have to prepare it from the equity shareholders perspective, what steps we have to follow and how we prepare the cash flow statement. And only if the long term funds perspective is to be borne in mind, then how the cash flow statement or the cash flows are to be worked out. So there are the four different perspectives or point of views where we can look at the project from, or the cash flow of the project from. First one is the equity point of view, right? From the equity perspective, or the equity shareholders perspective, we will have to work out the cash flow, and then we have to see that how much is going to be the return to the equity shareholders, because equity shareholders are the real owners of the company. So finally, they have to be provided the say good returns, because ultimate purpose of moving into the business is that they want to maximize the say their wealth or the value of their investment. And that would be only possible that if the sufficient returns are available from the project in the form of the profitability and other non-cash expenses, or the sufficient cash flows are available. So from the total cash flows, first of all, we'll pay the say obligations of all external fund providers. Maybe they are the lenders, the debt providers, or the preference shareholders, or maybe any other short-term financial fund providers. So we will have to pay all their claims. After that, we will have to look for that how much is left in the kitty that goes to the equity shareholders. So there is a process of preparing. The process of preparing the say cash flow statement, or working out the cash flows is different for the different stakeholders. So when you are preparing it only for the equity shareholders, it has a different process to be followed. When you are preparing for the all the stakeholders, long term as well as the short term, the debt as well as the equity, then it has a different process to be followed. When it's explicit cost, then it's a different process, and similarly for the total funds point of view. So normally we use the explicit cost funds point of view when we work out the cash flows. Explicit cost funds point of view, when we calculate the total cash flow for the firm, means how much, what is the explicit cost involved, or how much explicit cost of funds are involved in the project. So equity also has a cost, long-term debt also has a cost, short-term borrowings also has a cost, and even the preference capital also has a cost. So sum total of this becomes the explicit cost, and the funds containing that cost is called as explicit cost funds. So we will have to work out the cash flows from the explicit cost funds of funds point of view, or thereafter we will be preparing the cash flow statement for the equity shareholders point of view. And there are the different steps involved, different processes involved. So we have to bear those processes in the mind. So when we normally prepare the cash flow statement, or when we saw the cash flow statement which was given in the illustration previously in the previous lecture we saw, that was prepared from the perspective of all the say fund providers, or maybe the explicit cost funds point of view. What is the explicit cost of the funds, both for the equity and the debt? So from that perspective, we had prepared that cash flow statement, or maybe the cash flow was worked out. Even in the replacement project also, same is the case. We are not preparing it maybe only for the equity shareholders, or only for the long-term fund providers in the form of debt. So there are the different ways to do it. And finally, what is important is the measure of the cash flows and cost of capital. Maybe the cash flows and the cost of capital, we have to work out these two things. So cash flow and cost of capital, they must be consistent with each other. And as we saw earlier that normally we follow the nominal a nominal approach. We don't follow the real funds or the real, say, cost of capital approach. We don't discount the, say, nominal, say, cash flow, or maybe the, say, cost of the funds or discount rate against the inflation, and then we arrive at the real value of the cash flows or maybe the discount rate. But we normally follow the nominal process. So cash flow has to be nominal, cost of capital has to be nominal, because cost of capital we will use as a discount rate. So both have to be nominal, they have to be consistent with each other. So the point of discussion here is that when you are preparing the cash flows or working out the cash flows for all the stakeholders, both internal and external, debt and equity, long term and short term, then your discount factor, cost of capital, has to be WACC, right? Weighted average cost of capital. And if you are preparing it only from the perspective of equity shareholders or from the equity point of view, then it has to be only the cost of equity. The discount factor has to be cost of equity, because from that cash flow we have already paid the external claims to the fund providers, maybe long term fund providers in the form of lending or as a borrowing by the enterprise. So we have already settled their claim. Only now the funds left with us are due to be paid to the equity shareholders. So cost of capital would be cost of equity. But when you are using the explicit cost funds point of view, for that purpose the discount rate or the cost of capital has to be weighted average cost of capital. So normal course we use the total funds or explicit funds cost, and maybe for just maybe detailed understanding, we can dissect the cash flow statement from two perspectives, that is explicit cost point of view, maybe the total funds point of view, or maybe from the equity point of view, that is only for our internal purpose, that how much is the total cash flow, how much is the cash flow left to the equity shareholders. But generally for the external purpose, when we prepare the cash flow statement, we prepare it for the, say, total explicit cost funds point of view, or maybe the total funds coming from different sources. We do not pay the interest, we do not show the payment of the interest in the cash flow working out, and we say that whatever the net cash flow worked out is, that is due to be paid to the equity shareholders, preference shareholders, and to the lenders all. But if it is explicitly asked, or if you want to know explicitly that how we can calculate the total funds, means the cash flow to the total sources of the funds and the cash flow to the equity shareholders only, then we can dissect the cash flow statement and we can prepare it for the two different stakeholders or in two different ways. But it has to be consistent. If the cash flows is for the total funds or maybe for the explicit cost funds, then the cost of capital also has to be like that. But if the cash flow is only for the equity fund providers, in that case the discount factor also has to be the cost of equity. So this structure will help us to understand various point of views, right? Different or various point of views. Total funds involved in the business are, for example, 220 million, you can call it as 220 millions, and explicit cost funds are here, something like that, which you call it as coming from internal and external sources. Internal sources is the equity, maybe including the preference capital, we call it as, and then the external sources is the long term debt and the short term debt. So if you say here the funds coming from the equity are 70 million, long term debt is coming 75 million, and short term debt coming is the 45 million. So total amount becomes this is explicit cost funds, because you have to pay the cost on these funds, both on debt and equity. Equity also you have to pay the cost, and long term debt, short term debt you have to pay the cost. So when you talk about the explicit cost part here, so in the explicit cost part we will have to see, say for example when we are talking about the explicit cost part, so it means funds are being provided by the owners, entrepreneurs in the form of equity, that is called as an internal source of fund, and by borrowing or maybe by the lenders in the form of the long term and short term funds, which entails a cost, which involves a cost. So it means equity cost and debt cost, both the cost makes the explicit cost funds. So normally we work out the cash flows for the explicit cost funds, and later on we can include into this total explicit cost funds the other sources also, where we don't pay any cost, right? For example, the spontaneous finance, when we call it as spontaneous finance, is basically called as the current liabilities other than the bank borrowings or maybe the short term debt. So these are the spontaneous liabilities, spontaneous current liabilities or spontaneous finance, which can be sundry creditors, which can be bills payable. So you call it as they can be sundry creditors, right? They can be bills payable. They can be maybe you call it as the outstanding expenses which have become due but we have not paid those expenses. So till the time they are paid, we will be using them. That can be dividend also, to the extent it is declared, but it is not paid to the shareholders. It can be. So till the time you use these sources, you are not paying any cost. So they are spontaneous, self-adjusting sources of the funds. We call them the current liabilities, other than the short-term debt or the short-term borrowings. Short-term debt also is a current liability, right? But other than the short-term debt, any source of funding, maybe it's a sundry creditors who are going to be paid at the later date. Bills payable, again a kind of the sundry creditors. Outstanding expenses, when we are going to talk about is outstanding expenses. So they will be paid at the later date. So currently these funds can be used for the internal purpose. We have the dividend also, maybe it's a declared. So there is a time gap between the, say, date of declaration of dividend and actual payment of dividend. So these funds are used internally, but these funds do not entail any cost. So they are not explicit cost funds. They are free of cost. They are self-adjusting. Cost is paid, but indirectly on these funds. So explicit cost funds are only equity funds, long-term debt and short-term debt, on which, on this debt component, you will pay the interest at the different rates depending upon the term of the borrowings. And on the equity, certainly you have to return to the, or maybe return on the investment to the equity shareholders. So they entail the cost. So that's why they are called as explicit cost funds. And for example, in this structure, 190 is explicit cost funds, whereas the total funds invested are 220, but 30 is not going to be paid any cost directly. They will be self-adjusting sources, so the cost will be paid. Maybe that's inbuilt, and directly, explicitly, we don't pay any cost on that. So that's why it's not explicit cost funds. And in this explicit cost funds, 145 is the say borrowings. Actually, this is the borrowing, not a long-term borrowing. This is a total borrowing. This is, you call it as the long-term funds. So it's total, you can say, as the long-term funds, in the form of that this 70 is the equity and 75 is the capital. So these two are the long-term funds in the explicit cost funds, and remaining 45 is the short-term funds. So again, they are the explicit cost funds. And in this long-term funds, the 70 is the equity. So total is 220. Out of 220, 190 is the explicit cost funds, and out of this 190, 145 are the long-term funds, and in the long-term funds, the 70 is the equity and 75 million is the long-term debt, and remaining 45 is also explicit cost fund, but this is a short-term debt. So total amount becomes 190, means 145 plus 45 in this as the short-term funds. So short-term, say you can call it as the short-term borrowings or the short-term funds. So this will become, the total amount is the 190, which is explicit cost funds. And for this explicit cost of funds, we prepare the cash flows. The cash flow statement which we are preparing, that is only for this explicit cost funds. We will see that means after preparing the cash flow statement or working out the cash flows, we calculate something which is called as a net cash flow, right? We call as net cash flow. So that net cash flow is available to whom? That is available to the equity shareholders, right? They are available to the long-term debt providers, right? Or maybe the preference also. If it is not already adjusted, so the preference shares also, long-term debt providers also, and short-term funds, maybe we can say that yes to the short-term fund providers also, long-term as well as the short-term both. So in the form of the short-term debt also, so in the form of the long-term and short-term debt, equity and preference capital, because that cash flow is available now after paying all the cost. Now whatever the cash flow is worked out, that is a profit plus profit after tax plus non-cash expenses, all non-cash expenses. So this amount will be giving us the total amount of the net cash flows. This becomes the net cash flow. So this net cash flow will be available to be paid now to the, first we will pay to the long-term debt providers, short-term debt providers, and then to the equity shareholders. So it's a statement, or maybe the cash flows, net cash flows to be worked out to the sources of the funds which has a explicit cost, maybe a short-term or the long-term funds. So this way we prepare the cash flow statement or work out the cash flows, and the total cash generated will be invested for buying the assets. So this is application of the cash, fixed assets, and this is application of the cash of the current assets in the form of the inventory, credit sales, prepaid expenses, advance deposits, or maybe cash. So the 220 is equal to 220. So we are going for the two decisions. One is the financing and then is the investment, right? So first you will arrange the funds, so first funds will come into us, so it will be a plus sign, and then when it will go out, it will be a minus sign. But when the return will come from the investment, it will be a plus sign, and when it will be paid back to the financing source, it will be a minus sign. So this way the cash flow can be worked out. So in the normal course, when we have shown in the illustration also in the previous class, and now we will work out in the subsequent one class, we will calculate the cash flow ourselves also with the help of certain data given to us. That will be for all the fund providers or from the perspective of or point of view of the explicit cost of funds. We will not separately prepare it for the say equity shareholders or for the debt providers. You can dissect later on, that is also possible. Dissection of the cash flow statement is also possible, and when you dissect the cash flow statement from the explicit cost of funds point of view to equity and debt providers, then only thing is that while working out the cash flows for the equity shareholders, you have to pay the interest also itself in the cash flow statement. Normally we are not paying the interest in the cash flow statement when it is for the all the stakeholders, but when we are preparing it for the equity shareholders, all interest will be paid or shown paid in the cash flow statement it is. And finally, what net cash flow is worked out in that statement would be available to the equity shareholders only, because external claims have already been settled by way of paying the interest on the borrowings or maybe part of the principal as well. So after that, whatever the cash flow is left with us, net cash flow is left with us, that would be available to the equity shareholders only. But in the normal course, we prepare it for the all the stakeholders together and not dissect it. Now we will understand it clearly that what we are going to do while preparing the cash flow relating to the equity capital or to the equity shareholders. So here we will be talking about is that the equity related cash flow stream. The equity related cash flow stream reflects the contribution made and benefits receivable by the equity shareholders, So this will be the one way of preparing the cash flow statement or working out the net cash flow available to the equity shareholders. So first we will show that how much funds they have provided, that is a cash outflow by the equity shareholders only. So on the top, that will be taken as a cash outflow, and or maybe year wise when you are preparing it year wise. So for example, you are preparing it 0, 1, 2, 3, 4, 5 and like that. So here the outflow will be showing, for example 100 you are showing the outflow. This is only to be provided by the equity shareholders. So we are taking that cash flow here only, that is to be provided by the equity shareholders, not by the all. But when it is for all, then will not take it for the equity shareholders, but the total sources of the funds, debt equity plus debt, and then this 100 will be the total outflow or investment coming from all the sources which contain the cost. So that's the difference here. So in this case, maybe when we are working out the cash flows only for equity shareholders, then we are showing here the initial investment, but only that part which is provided by the equity shareholders or maybe in the form of the equity capital. So it's written here, equity funds committed to the project, right? This is the initial investment, only equity funds, not total. Debt component will not be the part of it. So only equity funds, for example, this 100 is outflow. So this is only provided by the equity shareholders. For example, total investment is 200. 100 is coming from equity and 100 is coming from the debt, right? So while preparing this cash flow statement, you will take only first 100 as a investment part or initial investment, that is only provided by the equity shareholders, and you will not take the total 200, right? This is the explicit or initial investment, you can say, coming from the equity shareholders. And then next step is to work out the cash flows, operating cash flows. So when you will work out the operating cash flows, so in this case, you will be taking into consideration, first of all, in the normal course as we are working out the cash flows, net cash flows, we'll take the profit after tax on the top, right, minus preference dividend, because that is also external claim. So because ultimately you are going to work out the cash flow for the equity shareholders only. Doesn't mean for equity or preference both. These are the both share capitals, but preference capital is considered as good as a debt on the company. So in that case, first we settle their claim. So profit after tax minus preference dividend plus all non-cash expenses, which is something like that, depreciation plus other non-cash charges which will be added into the profit after tax. and then in that you will take the terminal value or the liquidation funds, and terminal value would be in the form of the net salvage value of the fixed assets plus net salvage value of the current assets, right. So, this becomes the total inflow. This becomes the total inflow starting with the profit after tax. Means on the top you will say my outflow is that part which is given to us by the or to the project by the equity shareholders only. So, that is taken as the outflow. Then for calculating the inflow, so you will take the profit after tax. From that you will first pay the preference dividend. After that you will add back all the say non-cash charges including depreciation and the terminal value, that is the salvage value of the fixed assets and salvage value of the current assets, working capital. After that, now you have to make some payments. You have to make some payments because finally the cash flow to be worked out is only for the equity shareholders. So, in that case you segregate here from here, and these are the payments we are starting. So, now from the available cash flow you will go for the repayment of the term loan, right. This is only for equity shareholders. Repayment of the redemption of the preference capital we have already subtracted, but if any redemption of the preference capital has to be there, top is here we have taken only the dividend part which is to be paid, that is subtracted from the profit after tax. But in the lower part we are paying back the preference capital if it is due to be paid maybe in any particular year. Redemption of the preference capital, it may be possible that redemption or repayment of the loans may not be due in the initial years because you are preparing it for 5 years. So, in the first year there is no repayment of loans, you will write 0. There is no redemption of the preference capital, you will write 0. It may become due to be paid maybe in the 5th year, right. This is also in the 5th year and this is also in the 5th year. So, you will work out this in the 5th year. So, this is also the 5th year. So, this will be effective in the 5th year only. And then you have to repayment of the working capital advances and retirement of the trade credit and other dues, right. So, it means all these four things may be due to be paid in the 5th year, maybe the last year of the foreseeable life of the project. But before that you have to subtract something, and that is called as the interest. Interest you have to pay maybe from the first year onwards. So, interest component will be payable in this year also, in this year also, in this year also, in this year also, and in this year also. And in this year all other these claims also will be paid. That may be the repayment of the term loan, redemption of the preference capital, repayment of the working capital advances, and retirement of the trade credit and other dues. After that, finally, what net cash flow is left here, right? After calculating this, the net cash flow available here is, that will be available to the equity shareholders only, because all other external claims have been, this is available to the equity shareholders. All other claims have been settled. All other claims have been settled. So, this is the cash flow relating to the equity capital or the equity shareholders. And in this say cash flow, all other external claims, payment of the preference dividend, payment of say interest on the capital, all, or repayment of the principal amount of the term loan, or redemption of the preference capital, working capital, or the trade credit or any other short term borrowings, everything has to be paid. And finally, the net cash flow which will be worked out here is, that would be the cash flow only to the equity shareholders. And finally, if the project is closed at the end of the 5th year, then whatever that residual value is, that will only go to the equity shareholders. Then cash flow relating to the long term funds. Cash flow relating to the long term funds. So, it's again simple. The process is same. Initial investment first you will take as a cash outflow. So, you will be writing long term funds invested in the project. This is equal to the fixed assets plus the working capital margin, right. So, what happens that when you borrow the funds for the long term purpose from any source, right. Long term means any period which is more than 1 year. So, that is called as medium to long term borrowings. So, when you borrow the funds from any source, any institution, or maybe any other source, so there is a, you call it as a inbuilt clause in the borrowing agreement or lending agreement, that some part of the long term funds may be used by the firm or by the project management for the short term purposes or for the working capital margins. It can be. There is no need of taking any kind of permission or anything. So, that is a long term fund, but that can be used for the short term purpose, only a small proportion of the total loan given or total funds given. So that would be called as the total investment if you are calculating it from the long term funds point of view, especially the borrowed funds point of view. So we will take the total investment, only that part. For example, the total investment again is 200 million rupees, and out of this 100 is coming from equity and 100 is coming from debt, which is a long term debt, right? So this 100 will be our investment part here. This 100 is to be taken here, and this will be called as the initial investment while working out the cash flow for the long term funds or from the perspective of the long term funds. So this much is invested from the long term funds, and how much is now the inflow available. So operating cash flow will be profit after tax, we will take here as depreciation, we will take here as a non-cash charge, will be adding back to the profit after tax. Then non-cash charges all will be added back, and in this case interest on the long term borrowings minus tax rate will be added back, because this is not paid, this is not paid to the lenders or to the fund providers. If it is paid, then it means the balance would be the net cash flow available. So we don't assume it that the interest is paid. That will not be taken into account. Interest on the long term borrowings, net salvage value of the fixed assets, and then the recovery of the net recovery of the working capital. But this part is only will be taken into account from that part of investment which is created from the long term funds or maybe from the long term borrowed funds. So it means total investment when you are taking on the top 100 million, that is from the long term funds point of view, it means this inflow when we are working out, cash, operating cash inflow when we are working out, that is only for that part which belongs to the long term debt providers, not to the equity funds. Equity funds is separate. So it means we can sum it up that out of the total cash flow available, how much is going to the long term funds providers and how much is going to the equity funds provider, maybe internal and external fund providers. So in that case, we are very clear here that long term fund providers will be first we will be counting on their investment, maybe that part of the investment which we are making from the long term funds, and then how much is going back to them. So that part of the profit which belongs to the external fund providers, depreciation, other non-cash charges and interest component, and part of the terminal value of the fixed asset and the recovery of the working capital. So it means we are bifurcating it into two parts. Investment also into two parts, investment coming from the equity, investment coming from the debt, and operating cash inflow coming from the equity funds and coming from the debt funds, and then separately we are working out. So finally in this statement, the net cash flow which we are going to work out here is the net cash flow which will be worked out here, net cash flow that will be available only to the long term fund providers, because we have taken the investment here also from the perspective of the long term fund providers. So actually practically we do not go into this kind of the details, but as a student of project management you must be clear about that can we dissect the total cash flows being worked out in the form of the cash flow to the equity shareholders and cash flow to the lenders. Can we work out that? Can we dissect that? Yes, you can dissect that. But while dissecting this cash flow, you have to be very careful that when you are calculating the net cash flow to the equity shareholders, take the investment also only that part which is coming from the equity shareholders, and in case of the long term fund providers, take the investment also that part which is coming from the long term fund providers in the form of the lending. So if you mix up that, if you say the total investment is 200 and you put it on the top, it means you are saying that investment is coming from debt and equity, but the total operating inflow is going back to the equity shareholders or the debt providers, which is incorrect. So we have to be careful about that. And then is the cash flow relating to the total fund providers, which normally we do. The cash flow statements which we normally prepare is the simple process for calculating the cash flows. We follow this kind of the cash flow statement. We prepare this kind of the cash flow statement. And for cash flow statement, maybe we take the total investment, because this is from the perspective of the total funds. As we saw in the previous structure, 220 were the total funds. So when we take the total funds, so it means we have to take into consideration the funds coming from the equity, funds coming from the debt, long term as well as the short term, and funds coming from the spontaneous finance. So the total cash flow going back to the equity shareholders, to the lenders, and to the other respective stakeholders. This is a normal process, but sometime dissection is required. So, normally when we dissect the cash flow statements, so we dissect right from the cash outflow to the inflow, and then only we work out the say net cash flow to the respective fund provider, maybe it's equity shareholders or the lenders. So, in this case, cash flow stream relating to a total fund consists of the three components. Again, initial investment is the first component, right? Operating cash inflow is the second component, and terminal cash flow is the third component, which we have seen in our problem, which we saw the illustration which was already done. So, in this case, we will take the total investment. When you are talking about the initial investment, we are counting on the total investment, all the sources committed to the project, funds coming from all the sources committed to the project. This is simply the total outlay on the project, consisting of the fixed assets and the gross working capital, and funds coming from both the sources, and these sources can be internal, right, plus external, both the sources, the funds coming in, because we are taking all the sources, and then we are talking about the total funds coming from this, and this is the simplest way of preparing the cash flow statement. And while calculating the operating cash inflows, we take the PAT on the top, add back the depreciation, other non-cash charges, and we add back the interest on the long-term borrowings, because we will show it that this cash flow, net cash flow, which we are working out at the end, here the net cash flow which we are working out at the end, that belongs to all the fund providers, internal as well as the external. So, we will not subtract the interest. That is why normally we do not subtract the interest. Even in the profit and loss account, the interest is shown as paid. That is why the profit after tax is worked out, because it is after paying all expenses. So, in the profit after tax, we add back non-cash charges and financial expenses. So, depreciation we add back, other non-cash charges we add back, interest subject to the tax we add back, and short-term borrowing after the tax we add back, and net salvage value means that is a terminal value. Net salvage value of the fixed asset and net salvage value of the current assets we add back, and that way the total net cash flow we work out, and this cash flow is available to both, that is to the equity plus the debt providers. Equity and debt providers, to both this cash flow is available. So, normal course, or in the normal course, we are preparing the cash flow statement. We are working out the project cash flows by taking this kind of the process into account. But at any stage, for example, if you have to dissect it into equity and debt, so in that component you have to take the top investment only from the equity component or from the debt component, and then inflows have to be worked out accordingly, and you have not to mix up in any case that the total initial investment is from all the sources, whereas the operating cash inflows is only to the equity providers. No. So, it has to be dissected from the top, from the say outflow level. So, outflow is also from that source, and inflow also to that source, and net cash flow also to that source. But in the normal course, we follow this kind of the say we work out the cash flows like this, where we do not dissect the sources of the funds into debt and equity. We take the total funds on the top as an initial investment, then we work out the operating cash flows by taking the profit after tax, non-depreciation and non-cash charges, adding back, and interest costs also. And in that we add back the salvage value of the long term and the short term assets, and when we subtract this operating and terminal cash flow from the initial investment or vice versa, then we are left with something which is called as a net cash flow, and that is now available or to be paid to both the sources, that is debt and equity. So, the process of preparing the cash flow statement, or maybe working out the project cash flows, we worked out or we discussed in detail. So, some other relevant components of the working out the cash flows we will discuss in the next class. Till then, thank you very much.